So today we're talking about secrets to reduce taxes in retirement. Now, if you accumulated a lot of money, you potentially accumulate a lot of taxes that haven't been paid yet. Are there some planning things you can do to take back some control of when and how you pay taxes, hopefully to reduce them during retirement? That's what we're talking about next. Hey, this is Tommy Neesmith. I'm a financial planner at Christy Capital Management, and we're here bringing you retirement planning strategies for federal employees. Are there any secrets out there to reducing your taxes during retirement? Before we can reduce something, we need to know where the taxes will generally be for someone who's retired. First, you will be paying taxes on your federal pension. For most federal retirees, you'll be paying taxes on 85% of your Social Security income. Because your combined income will probably be over the limit for Social Security, you'll have to pay taxes. You'll be paying taxes on any distribution from traditional TSP or traditional IRAs. If you're getting the special retirement supplement, that will be taxed as well. When you reach the age 73 or age 75, you have to start taking required minimum distributions from your traditional accounts. Those will be fully taxable at whatever your tax bracket happens to be. One thing you'll notice here is that over time, potentially your income can go up. Maybe you retire and just have your pension and the supplement. The supplemental ends at age 62 and you may turn on Social Security. That will cause your income to go up. Maybe you have to start taking traditional distributions. That will cause your income to go up. And maybe you wait until the required minimum distribution kicks in where they force you to take some money out, and that causes your income to go up. So if you don't do any planning, what happens is that you can lose control over your income and thereby lose control of your taxation. If every source of income is taxable, you don't really have much choice. Also, with Social Security and with RMDs, you really don't have a choice on delaying them. Social Security allows you to delay until age 70, but then you have to turn it on. RMDs have a deadline where you have to turn them on. So if you happen to have enough cash flow to live in retirement where you don't need to turn these items on, at some point, you still have to turn them on and will have increased taxable income. The other taxable event that can hit you later in retirement is if you get bumped off the married filing jointly tax bracket down to the single bracket. This could happen either through the loss of a spouse or getting a divorce. If you suddenly get moved to the single tax bracket, a lot of times that acts as a tax increase because you move up that tax bracket so much faster in the single bracket than you do in the married filing jointly tax bracket. Then at some point when you pass away, you will leave your remaining money to somebody. If it's traditional money, it's going to be taxed to your beneficiaries. It seems like a never-ending, lifelong battle with taxes. Here's the starting point of what your future taxes may be. So, now let's talk about things you can do to try to minimize and reduce those taxes. The first step is looking at your tax return and figuring out a Roth conversion strategy. Can you figure out a systematic strategy to do year after year that moves traditional money over to Roth? What tax bracket are you comfortable with paying taxes at? Finding that bracket and then maximizing it out each year by doing Roth conversions can be a way to take advantage of today's tax rate, especially if you think next year or 10 years from now's tax rates are going to be higher. If taxes get worse in the future years, then doing Roth conversions at lesser rates would be beneficial to you. This is a year-by-year strategy. Let the Roth conversions do the heavy lifting of shifting as much as you can without going up into tax brackets that you don't like. This is one way to take back control of when you pay your taxes and what rates you pay your taxes. Of course, as we often point out on this channel, this is something that the TSP just doesn't let you do. If you want to do Roth conversions, you can't do it inside of the TSP. You will have to move your money into an IRA to then start doing Roth conversions. Now you can do this on your own. Sure, you can. You can open up your own IRA somewhere and your own Roth IRA somewhere and do this. Are there some potential pitfalls that you can run into if you're not thinking through everything? Well, I'm sure there are. So if you need help with this, please reach out to ChristyCapital.com. click on Talk to an Advisor and we would love to help you with this. There's more to it than just doing a Roth conversion. How much are you going to do? How often are you doing it? What time of the calendar year are you doing it? There's a lot of ways where a professional can provide value to you in this area. You know, another secret to reducing taxes in retirement has to do with charitable giving. When you reach the age of 70 and a half, you can do what's called a qualified charitable distribution, or a QCD. This is where you give money to a church or charity directly from your IRA, and you, nor the charity, pay taxes on it. So if you're someone that gives to your church or charity on a regular basis already, then this would be something you could use. And when the IRS increased the standard deduction several years ago, we know lots of people, you're just not able to write off charitable giving anymore. The standard deduction is higher than all the itemized deductions, and charitable giving would be an itemized deduction. So let's look at this case. Let's say you give $500 a month to your church or charity. That's $6,000 a year that you're giving. But for you to be able to give $6,000 out of your checking account, you'll have to take or earn $8,000 and then pay taxes on it, netting you the $6,000. You would have two choices with a qualified charitable distribution. You could give $8,000 during the year from your IRA and have it go straight to the church or charity. The church or charity would then receive the full $8,000. No taxes would be paid to anyone. The church or charity didn't pay taxes, and you don't pay taxes. So where ordinarily you would have to earn $8,000 and pay taxes to give $6,000, you would not have to do this in this case. You can always give the full amount. So in this example, you can either give $6,000, pay the taxes and give it, or you can give $2,000 more, $8,000, and not pay any taxes. Just from sending it directly from your IRA to the church or charity, they are getting more money and you're getting to take advantage of the tax efficiency of the gift. So this extra feature either allows you to be extra charitable at no extra costs, or allows you to save money and maintain the current amount of charitable giving. Once again, this is something that you cannot do inside of the Thrift Savings Plan. To do a qualified charitable distribution, you have to be 70 and a half years old, and you have to have the money in an IRA. Now, does this feature save you so much in taxes that it's going to convince a non-charitable person to suddenly be charitable? Probably not. But if you're already charitable minded and you're already giving money consistently to churches or charities, you can have the money come directly from your IRA starting at age 70 and a half. This is another way that working with a professional that understands how the system works can help you accomplish your goals better by either being more charitable if that's your goal, or by saving on taxes. Either one of those options are good in my book. If you need help planning for your retirement, go to christycapital.com and click the Talk to an Advisor button. If you realize that maybe Roth conversions are something you should start doing and you want to know the best way to pay taxes on a Roth conversion, then watch this video right here. There are multiple ways that you can pay taxes on a Roth conversion, so make sure you check out which way may fit your situation best. My name is Tommy Neesmith. Talk to you on future videos.